A tech story. It's very much a defense one, to your point. That's reflecting already in the indexes. You're seeing that in some of the frothier parts of the European market as well. On top of some of the sector stories that we're going to see, we'll throw Ubisoft in there as well. The story around some of their leverage, some around their covenants is a little bit complicated, but something that the market could react to at the open, Guy.
Tech defense, let's see what happens here. Let's see what happens with the banking sector as well. That could be interesting too. There's a lot going on this morning. Here we go. Right, Friday session is almost upon us. Let's give you some numbers. Let's give you an idea of what is happening. FTSE 100 in theory should be defensive. In theory, it's going to be interesting to see how oil stocks react to a move lower there. Is it going to be that defensive this morning? Are we going to see maybe the commodities trade actually unwinding a little bit through the FTSE 100 too? The Stock 600 is down 0.6%. A lot of that's kind of UK action at the moment, but look at the IBEX. Down by nearly 1.5% this morning. Big move lower in Spanish equities. What are we going to see on the AEX this morning? How is ASML going to open? There you go. We're down by nearly 1.7% on the Dutch market. The CAC is down by 1.25%. We'll give the Germans a little moment to get things going there, but you expect defense stocks to be under significant pressure. So there's a sea of red out there basically for European equities this morning. Little bit of kind of defensiveness maybe coming through in the FTSE 100, but that's a relative trade, not an absolute trade. And that's significant. But look, yeah, pretty ugly session at the get-go this morning. Looks like tech's going to be under pressure, judging by what we're seeing in the AEX. Val, what do you got?
Look, tech is definitely under pressure. The biggest points loser so far on the Eurostock 600 is ASML, down over 5%. The biggest drag on the wider index this morning, and tech is at the bottom of the basket when it comes to how we're looking at the sectors. 446 stocks are opening up in the red. Only 82 are opening up in the green. We do have two sectors in the green at the moment, food and beverage, maybe on the back of Nestle and Unilever. Those defensive stocks look like they're doing well today, but at the bottom of the basket, we have energy, technology, and basic resources.
Basically, if you're a heavyweight or have been a heavyweight in the European market, you are selling off in a very big way. It's magnifying the fears that you saw around the valuation story in tech, to your point, because the heavyweights on this side of the Atlantic, it's your healthcare stocks, it's your energy stocks, arguably it's your banking stocks as well. So that's where your pain is. I thought the interesting defensive story about, you mentioned the Unilever, the Nestle piece, you've got Roche in there, you've got Haleon in there, you've got some of the telecoms in there as well. So there is a defensive trade that is outperforming today.
Which is interesting. I get it, but also the consumer's under pressure right now. So in some ways, actually,
I'm not sure logic matters at the moment.
Well, no, you're basically running from one side of the ship to the other.
Yeah.
And we've seen a lot of that recently. But it's not as if the consumer is doing that. Look at Walmart. People are trading down. You've got the Walmart trade yesterday, which I thought was really kind of telling. Walmart's doing well, which is something you really want to pay attention to. And when people trade down, they trade away from actually some of the high-value stuff, like the kind of the high-end consumer goods, FOMC, fast-moving consumer goods that Unilever and Nestle make, and you trade down into white goods. So how safe are some of these stocks? Also, you look at some of the multiples that some of the Costco's and people like that trade on in the States. They are super high right now. But anyway, the market's looking for safety this morning. Unilever, Roche, Deutsche Telekom, Nestle, those are the kind of companies that are being bid. Off the back of it.
I haven't fully gotten to nerd out about Walmart just yet, but I'm very glad you did. It's a fascinating one. They're still talking about higher costs. They're still talking about a tariff read-through, just not immediately, which I think is a fascinating one. Let's get a little bit more insight in terms of where this market is moving next. I'm pleased to say Daniela Antonucci, CIO over at Quintet Private Bank, joins us around the table. What do you make of this? What's driving the red on the screen that we're seeing today?
Well, I think it's a follow-through from yesterday. I think it's very interesting the way you described it. You had all green in the morning and a very different picture, all red in the afternoon. I also think when you look at things up close, they tend to be bigger, I think. To me, the big picture is still one where you have rates coming down, tariff uncertainty coming down as well. You have big fiscal stimulus pretty much everywhere apart from the UK. And also you have big AI spending. So the outlook to me looks constructive. Then the biggest challenge is probably that a lot of this good news is already priced in. But the outlook itself, the baseline, seems to me positive going into next year.
Do you buy the STIP then?
Yes, I would. So we haven't changed positioning. I think you need to look at things in a less binary way if you think about it. Even the conversation around AI, bubbles can inflate for a lot longer than you think, and then they burst a lot faster than you think, but at the end of the day, you don't get a calendar invite for that. So you need to think about the several dimensions here. So the first one is that tech, AI is not an homogeneous sector. I think the smaller, weaker, less profitable, more indebted names, if you look at the range of outcomes, yes, they are towards the probably end of the spectrum. But the larger hyperscalers, the obvious competitor is the dot-com period. That I think is very different, right? You have strong earnings growth. It wasn't rewarded, NVIDIA, but you still have strong earnings growth. Valuations on the demanded side, you could say, but not as demanding as back then. And so far, a lot of the spending, rather than via mispriced debt, has been financed via free cash flow. So very, very different, and we do buy those.
Okay, so you're looking at tech companies who aren't necessarily using debt financing at the moment. Is that correct? You want ones that still have that steady free cash flow that aren't necessarily tapping these credit markets like the hyperscalers have?
We look at any company in this way. We look at companies that produce mission-critical products and services that you cannot do without, try to live without your Microsoft Mobile or whatever application. Yes, we look at the debt picture as well. We look at earnings prospects, and I think they are strong. And there's one thing that we have learned is that we tend to overestimate the near-term impact of things, the 1 to 2 years, but also we underestimate the 10-year out picture.
Yeah. So Daniele, when you're looking at buying the dip here, does the move in cryptocurrency that's extended this morning unnerve you somewhat? Is that a barometer for how you think risk is going to trade?
That is kind of the riskier part of the spectrum, if you think about it. Whether it is hedging your NASDAQ exposure, we'll see. So there could be a lot of dynamics. I think when it comes to that, this is a healthy correction. This is likely to reset. To me, after the holiday period, the Thanksgiving, will provide opportunities, but the important thing is that our strategy is one that sticks to the plan. Unless Feds fundamentally change, we stay invested. I think investors should be exposed to AI, but in a diversified manner. For example, if you look at global equities, the US is 2/3 of the total. We don't do that. We are more like closer to 50% and have reallocated to other sectors, to other markets, because we want to be exposed, Valerie, to return opportunities wherever we can find them and to mitigate risks wherever they come from.
Are you hedging at all?
Yes, we do.
How?
We hedge in 2 ways. So the first way, when you think about equities, we use options.
Yep.
You should think of it like an insurance policy.
How far out are you taking those options?
We can roll them, but now it goes through year end and
You're not doing long term.
and into the new.
No, 1 year out. You're doing
sometimes we do. We could do 3, 6 months, 1 year out as well. But like any insurance, think for yourself when you get out of your home to come to work, how much you are prepared to pay to be insured against each and every risk. Half of your salary, 2/3 of your salary, all of it. So these things have a cost. You pay a premium for that, but that's one way to hedge. The other thing we hedge is the currency. That has changed very much in our strategy. We used to buy US equities unhedged for the most part, but now nearly half is hedged because the view that I have is that the dollar is likely to weaken further next year. We're European investors or sterling investors, and so when you translate those gains, you tend to lose quite a bit.
What do you think of valuations right now? Are you comfortable with valuations, kind of CAPE indexes? Like, I hear a lot of people talking about the fact that we are at historical highs. Does that not give you pause for thought?
So first of all, when you think about valuations, this is not your timing, not your day-to-day.
Sure.
If you look at forward earnings 1 year out, you have lots of years with demanding valuations and bad performance, but also as many years with demanding valuations and a really good performance. So the strategy of crystallizing a loss in the portfolio to get back in at a higher level, who knows when. It's not a particularly winning strategy to me. We look at valuation, it's a risk. Before I mentioned that a risk to the outlook is what's priced in. It's not just equity valuations, by the way. Gold has been surging.
Sure, everything has.
That's another example. But there are, within equities, markets where you see more value. For example, tactically, we're reallocated for some time to emerging markets. That's a value trade.
Yep.
Europe, I would describe valuations as maybe average relative to their own history, but compared to the US, still attractive. That is another area where we have been reallocated. So you need to think more about the strategy of portfolio diversification as opposed to valuation standalone.
Daniele, given your bullish backdrop, is what we're seeing in private credit worrying you at all? The fact that it's an opaque sector, it hasn't gone through a slowdown before. We saw Blue Owl trying to merge these two funds and force a loss on these investors. They've recently reversed that. Is there anything that would concern you that this could turn into something maybe you needed to hedge against, or maybe in the future would make you less bullish on the U.S. mega cap tech trade?
I would describe my outlook as constructive as opposed to bullish. The reason why we are already exposed to that, I don't think I would increase my exposure to the U.S. I mentioned before that if you look at how we allocate compared to global equities, actually we would have a reduced exposure to that. But compared to our normal long-term strategic allocation, we have an overweight, if you like. I have diversified in many other ways other than geographies. For example, we bought an equal weighted index that gives you more exposure to sectors that could benefit from the next leg of US policy, financial deregulation, fiscal stimulus as well. So I would say we are constructive, but I have knowledge that one risk is market pricing in general or valuation. In private markets, obviously, it's a lot more difficult to get the transparency and the real-time information that you have in public market. Yes, it is a risk. At the moment, we have concluded that some of these cases look more idiosyncratic in nature rather than systemic, but it's one risk factor that we are watching very much.
Daniele, great to see you. Thank you very much indeed. Positive view this morning. Daniele Antonucci, COO at Quintet Private Bank. Okay, let's take a look at the Core 6. We've already kind of discussed some of the movers that we are seeing. To the right-hand side of the screen, you have safety. To the left-hand side of the screen, you don't. And you've got Novo, LVMH, Rheinmetall, ASML, and Schneider all under pressure. What is interesting, actually, is the luxury trade isn't doing that badly this morning relatively to some of the other positions that we are watching. But defense and tech are both under significant pressure in this market this morning. Let's get more details on what we're watching. Let's start with tech with Chloe Mellet.
Good morning, guys. So yes, we have got a wall of red across those AI-related, tech-related names today as concerns over lofty valuations, over whether or not this really heavy spending on AI will pay off are now back. We had a little bit of a relief yesterday after NVIDIA's earnings and the really upbeat forecast that we had that really drove those shares in that sector forward. But now it seems that the market has changed its mind again about the potential for this AI bubble, and we are back down. And we can see, in particular, ASML is down 4.6% this morning on the back of that. It is the one that is seeing the worst downward move there, but we are seeing really this wall of red across that AI-related sector. Moving on to defense, and we have got the same, also a wall of red there, and that is after Zelensky said he was willing to work on a peace plan that was put forward by the US and Russia. This is a peace plan that looks to be given into a lot of Putin's demands, including demanding Ukraine cap the size of its military. But the fact that there is the prospect of peace there is dragging down those shares across the defense sector. Babcock is also down because they reported earnings that disappointed a little bit this morning. So we have got a double whammy there for that UK defense company, but we can see across the board we are down for that defense industry. Moving on to ASOS, and ASOS is also down this morning. The retailer reported a profit that was, well, a loss actually, that was wider than expected. And moving on to CTS Eventim, which is a company that sells concert tickets. The profit growth came in ahead of expectations. They also appointed a new CFO, and that ends some of the uncertainty around the leadership moving forward for CTS. And so we are up quite significantly this morning for that company. We're up 5.5% there.
Chloe Mellet from our equities team walking us through some stocks on the move this morning. Coming up next, we'll turn our attention to Bitcoin and cryptocurrencies, continuing their tumble to multi-month lows amid a broad flight from risk assets. More on that next. This is Bloomberg.
coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
Very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress-testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Morning, how are you doing? 60 minutes into the equity market session. We have French PMIs to pay attention to. The manufacturing number is not good at 47.8. That's down from 48.8, well below expectations. However, French services look like they're bouncing back quite nicely. They're above 50. We're at 50.8. The expectation there, the survey was 48.5. The last number was 48. So French services looking pretty good right now, despite all the political turbulence that we're seeing. That takes the comp number to 49.9, basically 50. Basically flat. Remember, this is a diffusion index, so you just got to kind of bear that in mind in terms of the kind of how you should read this. But nevertheless, that's a flattish picture, and services, which is a big chunk of the economy, coming back.
And we'll bring you the German numbers breaking in just under 15 minutes as well. But switching focuses to the cryptocurrency market, Bitcoin on track for its worst monthly performance since a string of corporate collapses rocked the crypto sector back in 2022. Let's get more from Bloomberg's senior editor, Ann Herrera, on this cryptocurrency move. What's driving this sell-off today? And do you think that this is what's impacting wider markets?
I think maybe it's the other way around. I don't know if Bitcoin is a bellwether of risk yet. It seems like Bitcoin is more moving with stocks now and with more riskier assets. So there isn't exactly a reason why perhaps it's falling this much today. One thing in crypto market is that they're highly leveraged and they're still quite retail driven compared to other markets. And crypto exchanges have these things called auto liquidation. So when there's a downfall, it tends to happen quickly and exaggerated because traders will get auto liquidated. So that tends to exacerbate collapses in prices.
How much of this is, we've been debating this across the board about whether or not this is ultimately retail, ultimately if this is institutional, what's actually driving Bitcoin that seems to be driving the rest of the market? How much power does retail have here?
So it's still very much a retail-driven market, and we've seen that if retail investors haven't come back in, maybe they know by now that when falls start to happen, they tend to continue. But we've seen in the past year or so, Bitcoin ETFs and more institutional buying on that front. So it could be that it's a mix. There's been a lot of selling with Bitcoin ETFs as well.
All right, Bloomberg's Anna Herrera walking us through some of this price action that we're seeing. Who knew that this global sell-off that we're seeing would start off with cryptocurrency. I don't know if I could make that case about 5 years ago. We're also, of course, monitoring the FX space and the bond markets as well. Some of them may be taking their cue from crypto. Others may be taking their cue from what's going on the other side of the world. Japanese Prime Minister Sanae Takaichi's government has approved the largest round of extra spending since the pandemic. Funds looking to be deployed to address the frustrations of voters. But it's a package that could unsettle investors that are looking at the nation's finances. Let's get a little bit more insight here. Zuhair Khan, Senior Portfolio Manager over at UBP Investments, joins the program. Zuhair, just how much trouble is Governor Ueda's hiking ambitions in the face of this fiscal stimulus?
Well, I would hope that he would still hike. I mean, the expectation is he won't hike in December and that he most likely will hike in January. I think inflation is a problem in Japan. I think interest rates are too low, behind the curve. Earlier when there was a lot of uncertainty around Trump tariffs and the effect of the tariffs, I think it was sensible to wait. But I think that's, settled down as much as you can imagine things can settle down with Trump in charge of tariffs. So I think it would be better if he does hike sooner rather than later. And his not hiking is a big part of the reason for the weak yen, and that is adding to inflation troubles in Japan because food and energy are imported and they have a big impact on inflation. So I think the case for hiking is much stronger than the case for not hiking.
Okay. What about the case for intervention? Are we going to see that? Is that what's going to happen this weekend? Long weekend coming up, perfect time, some would argue, for getting into the market.
Absolutely. I mean, in reality, I think intervention only has a very short-term impact. It's very difficult for the government to have an intervention of a scale that, has anything more than a temporary impact, right? Unless it's sort of coordinated, let's say, with the U.S. But that's not likely to happen. They may do it just to tell people this isn't a one-way trade. But I'll say one other thing. What's interesting is that although Takaichi put out a rather large package, but if you look at the longer-term Japanese government bond yields, actually, they have come down a bit. They went up a lot in anticipation of the supplementary budget announcement, and they've actually come down a bit once it was announced. So I think it wasn't as bad or as large a package as people expected. Yeah, there'll probably be the intervention, or I shouldn't say there probably will be an intervention. I don't think you can rule it out. Given the low liquidity, that's when you would want to intervene if you were going to do it.
But Zuhair, do you not see, at least on the week, if we take a step back, we've seen the yen weaken near 2%, and we've seen those 40-year JGBs, breach record highs. They're up around 13 basis points still on the week. That kind of asset correlation isn't necessarily something that would soothe investors' worries about a possible sell Japan trade somehow igniting if we get weakness in treasuries and maybe even weakness in gilts after next week's budget announcement. Is that kind of price action making you rethink some of your allocations?
No, so I think a sell Japan trade would be quite mistaken. I mean, first of all, Japan's government debt to GDP has actually been going down, and this has been helped by inflation, right? So that's the one place where inflation has been good. Inflation has been high, and it's inflating away a meaningful amount of the debt. So I don't think the effect is as negative as it should be. The second thing is Japan's problem is not that the government overspends, it's that they actually undercollect on taxes. A lot of Japanese pay very low or little taxes. If you're a salaried employee earning a high income, yes, you pay very high marginal taxes, but the average Japanese doesn't pay very much in taxes. And then Japanese small businesses and all, I mean, they take write-offs on everything and end up paying very little in taxes, and they sort of put every expense they can into the corporate account. So Japan has more of a tax collection problem. And then as a nation, Japan is the world's largest net creditor nation, and it produces a net surplus every year. So they're lending more to the rest of the world every year. So they're, Japan as a country can't go bankrupt. All it means is they're going to need to tax the Japanese people a bit more in certain ways, especially wealthier Japanese.
Is there any risk of a Liz Truss moment in Japan?
I think it's unlikely. It's something that I think a lot of people are more and more so talking about, but I think it's driven more by sort of rising interest rates in the rest of the world on the long bonds rather than Japan. I mean, Japan doesn't depend on foreigners buying their bonds.
Yep.
It's something the government can control. It's just they don't have the political will to do it.
Okay. Maybe they'll develop that political will. Zuhair, thanks very much indeed. Zuhair Khan, Senior Portfolio Manager at UBP Investments, joining us out of Tokyo. Head of a long weekend in Tokyo. An interesting weekend, potentially, in Tokyo. I want to pay attention to what is happening in Frankfurt now. We are about to hear from Christine Lagarde, the ECB president. She is about to be introduced. She will be on stage momentarily. What I think is interesting this morning is that the euro has been steadily climbing throughout the session. Now, I don't think this is in any way related to what Christine Lagarde has been saying, but I just want to highlight as well that if you are a euro investor, year to date, you are now negative in terms of your performance on the S&P. So you're down by 0.3%.
Well, does that say more about FX or what's going on in the equity market?
I think both. I think, to be honest, I think European equity markets have been outperforming, which I think is fascinating. They're definitely outperforming in local currency terms. It was interesting. Our guest before last, was talking about the fact that they're currency hedging their US portfolio now because of potentially this kind of risk. But the euro, Lagarde I don't think Lagarde's changing strategy at this point in time. Is that all she's got to do? Nobody feels like nobody feels very interested in the ECB at the moment. You just sit back, deliver policy as it is, and keep going, and kind of the movement's going to come elsewhere.
Yeah, I mean, at least when it comes to the ECB, really no economists are expecting major moves in the next 12 months. You even look at that in the front-end rate pricing as well. Clearly, the focus is more on the Fed, the fractures there, potential intervention out in Japan, causing the move in FX rather than any catalyst really coming here from Europe. But we are monitoring the PMIs. Those German figures are out in less than 4 minutes.
Yeah, it's a fascinating one, though, and I think one of the conversations, let's just kind of connect every single thing that we've been talking about this morning. We started off this morning talking about Japan, the BOE. We just had that conversation with Zuhair Khan as well. The through line, at least to me, seems to be that we're positioning for an economy and we're positioning for a market that is not going to change in terms of the geopolitics, some of the inflationary shocks, that the tariff read-through has largely priced in. Now it's more of a fiscal growth story. You're seeing that in Japan. You're seeing that at least in some of the indications coming out of the ECB, and potentially something that could be reinforced in just a moment. There's a question here, though, about is fiscal stimulus inflationary, or is fiscal stimulus prolonging some of the weakness that you're seeing in other parts of the market? And that's a conversation happening in the States as well.
Absolutely. And you've got the midterms coming up as well, and this kind of need maybe to deal with inflation, which is clearly a political concern. But on the other hand, the Trump administration wants to put money into people's pockets, which will potentially help deal with the inflation, i.e. pay for it, but also potentially prolong it. So I think there's all kinds of sort of concerns around that. I'm surprised that Christine Lagarde, in some ways, given the financial instability that we are seeing being flagged by other central banks at the moment, she's at a banking congress in Frankfurt. I'm surprised that there's not a few more lines in here, and I haven't read through the speech fully yet. There's a few more lines in here, just kind of warning about some of the risks out there that people like Lisa Cook are flagging, and also the Bank of England has been flagging. She's not. That doesn't seem to be a big concern for the ECB at the moment, the financial instability story that other central banks clearly are becoming more alert to.
Yeah, and those two things are AI valuations, what a possible derating in these companies could mean, reverberations in the financial system, and then the other big fly in the ointment is private credit. Frankly, we've had the Bank of England say some pretty strong things about the topic. They're monitoring it. Yeah, I know the market necessarily isn't as big here in Europe, but the insurers are definitely involved in U.S. private
People
credit.
just don't. There's no obvious line of sight that central bankers normally have.
I'll argue the opposite of what you said, because I agree with Guy here. There is no insight, and yes, it is a smaller market, but it is still your primary financing market. Whereas you can look at the public markets for cracks, the repo funding pressures, et cetera. In the States, you do that in the same way. Some of these financing lines that are coming from the Apollos, the KKRs, the Premieras of the world, that's what's
in Europe, banking is still the primary source of financing.
Yeah,
by a country mile, and that's in some ways that's a bad thing. Ideally, you want to have like a deeper credit market that you want to be able to find. But in some ways, at the moment, maybe it's a good thing. I don't know. But
you can argue that about the AI trade as well.
Yeah.
Maybe it's a good thing they're not getting over involved in these data centers, right?
We don't know
if the
yet.
tide turns, maybe Europe will have its moment then.
But Lagarde is not. I wonder what is happening under the surface at the ECB. I wonder whether those concerns are surfacing in the same way, beginning to come to the surface in the same way. This is a perfect audience to listen to that kind of message, but she's not maybe focusing on that. Anyway, we're going to get her speech. Well, we've got her speech. We're going to hear from her very, very shortly. But the euro is up, and that's a factor as well. The currency story has been a big narrative this year, and it feels like the ECB is less of the story at the moment. It's the reticence of the Fed to cut at the moment that seems to be kind of one of the main kind of drivers here. But is it translating in the same way as you would normally anticipate? I don't know. European stocks are certainly under pressure this morning. Crypto has bounced off its lows. We got down to 82. We're back up to into the 84s. It kind of feels like we're looking for the next moment now in this session, which could be quite a bumpy one. I'm not convinced Lagarde's going to provide it.
We got some new data on our hands, Critty.
We got some new data on our hands coming out of Germany this time, which I think flows nicely, given that we are, of course, waiting for Christine Lagarde's comments in Frankfurt. I'll just break them here. Germany's November composite PMIs falling to 52.1. The forecast there was 53.5, so still kind of in expansionary territory, but less so than what we had anticipated, at least in the expectations. You break that down via services and manufacturing. We're looking at 52.7 reading. The forecast is 54 on services. It gets worse in manufacturing, and that's really where we're seeing the pain point. And that's something that's coming up time and time again from the ECB story, which is what effect is China having? Is the German market, if we're trying to create all stimulus, is the industrial complex still dependent?
Where's this Mertz boom? Where is it? It's not showing up in it's not showing up in the employment.
With exuberance at the beginning of this year.
Yeah,
it's in the Rheinmetall share price.
It's not this morning. We were expecting this big Mertz boom, and it feels like it's becoming. It's been questioned now, isn't it? And the data are not coming through out of Germany that we were anticipating. It feels like it's being pushed to the right in terms of when this stimulus starts to have an effect on the German economy, because it's not showing up at the moment. The manufacturing numbers are weaker than anticipated. The services number still above 50, but weaker than anticipated.
Yeah.
The frustration is growing that this is not a reality yet for the German economy. And this was meant to be this kind of economic driver that we've been waiting for to kind of kick into gear. When does it happen?
Well, the defense conversation is so crucial there, and we've been talking about it from a kind of stock market perspective, that the really lofty valuations, the Rheinmetalls and co. of the world, whether or not you are seeing this fiscal impulse, is something you've seen the ECB governors kind of warn against as well. Let's talk a moment about, though, some of the other news lines that are coming out. There's a peace plan that's being proposed, that's being discussed in the background of all of this. And we had this conversation earlier in the week of, is this something that's actively tradable or even factoring in to the defense stock conversation? We're seeing it more closely in the Brent crude space or the nat gas space. That's where we're seeing a bigger reaction rather than the defense stocks and a more clear read through there.
Yeah, okay, let's get some reaction on what is happening with the PMI story and try and figure out what is going on there. Zoe Schneeweiss is covering it for us. Zoe, what do I make of the data that we've seen this morning, both out of France and out of Germany? The German data looks a little weaker than anticipated, as we anticipate Christine Lagarde sort of speaking very shortly. What do we make of this data? What should we make of these numbers this morning?
So the French numbers, as you mentioned, were better than expected. France is now, the composite number is 49.9, so that's basically stagnation. The German numbers are still in growth, as you said, but are a lot weaker than we had thought. And with Germany, it does always feel like recovery is just a quarter away. So the Bundesbank told us yesterday that they thought that there might be very slight growth in the fourth quarter, and those PMI numbers today would confirm that. As you highlighted, the manufacturing number is the one that is the scary one here,
Manufacturing has been below that 50 level that divides growth and contraction and PMIs for months now. But they were edging closer and closer to that 50, and now they're going down back below 49 at 48 points something. So that's just bad news, and it's just disappointing that everything takes so long in Germany.
Zoe Schneeweis joining us on the latest PMI figures. Remember, we'll also get the broader Eurozone figures out at 9 a.m. The UK figures out at 9:30, and watch those US ones dropping at 2:45. For more on the European economy, let's hear from the ECB president herself. Christine Lagarde has to say in her keynote speech at the Frankfurt European Banking Conference.
Mayor, dear Mike, dear co-host of the Frankfurt European Banking Congress, esteemed guests from the financial sector and beyond, I would like to start, as I occasionally do, with reading for you a quote. It goes that way. The world around us does not stand still. In recent years, the global environment has been transformed in ways that none of us could have imagined. We have seen the post-war global order fracturing, the rise of new and some old powers, rapid changes in technology, and an uncertain outlook for global trade and finance. Sounds familiar? It should. Because I'm just quoting myself. And that was here 6 years ago, November 2019. And November 2019 was before the use of AI, or the rise of AI. It had been launched, but ChatGPT was a teeny tiny little thing that nobody really knew about. It was before the re-election of President Trump and his projects. It was before the unjustifiable, brutal invasion of Ukraine. And it was before COVID. And yet. So in that speech, what did I do? Bettina, you're right. I urged Europe to recognize that its old growth model, built on export-led growth, was coming under strain. And I called for a shift to focus instead on developing our domestic economy, and when I use domestic, I talk about Europe. Our domestic economy as a source of resilience in an uncertain world. And my point was not, if you remember, to argue for protectionism or inward-looking policies. It was about realism. It was about recognizing that the world was as it is and not as it was. And it was about acknowledging that the solution was already in front of us. And Jean, you alluded to it, the untapped potential of our own internal market. 6 years on, a lot has happened. But the diagnosis that we had back in 2019 has become just clearer, stronger, and more urgent. Europe has become more vulnerable, also due to our blatant dependency on third countries for our security and for the supply of critical raw materials. Global shocks have intensified with rising US tariffs, Russian aggression, and stiffening competition from China, to name a few. And at the same time, during the same period, our domestic internal market has stood still, especially in the areas that will shape future growth: digital technology, artificial intelligence, and in the areas that finance these shaping growth sources, our capital market. And as Galileo said, yet it moves. Europe continues to show resilience, revealing sources of strength that could grow if only we allowed them to do it. So the two questions that I would like to discuss today is, number one, how do we move from being vulnerable yet resilient to being strong? And what will it take to achieve this goal? And I think we have what it takes. And it is not as complicated as we think it is when we bash our head against the walls of complexity in Europe. More on that later. So let's look at the vulnerabilities that you all know about, but I'm going to try to give you some specific examples so that it gives credit to the ECB research and our staff, which is working hard on those issues. So those vulnerabilities stem from having built a growth model around the world that is gradually disappearing under our eyes. We embraced globalization more than anyone else in the world. Well, China probably embraced it a bit more than we did, but in the advanced economy, certainly we were the most advanced. In the 2 decades before the pandemic, external trade as a share of GDP almost doubled in the European Union. It didn't move an inch in the US. And this deep integration brought significant benefits. The number of jobs supported by EU exports rose by 75%, reaching almost 40 million people working for export. And for many years, this was a great source of resilience. But today, that same openness that we celebrated for 2 decades has become a vulnerability. Exports have become a far less reliable engine of growth, reflecting the changing global landscape. Just recently, because we have seen amplification of most phenomena that were in the works for a long time. In mid-2023, for instance, the ECB expected exports to grow by around 8% by mid-2025. You have the same numbers coming out from the WTO. In reality, they have not grown at all. And looking ahead, exports are projected to actually subtract from growth over the next 2 years. This has been felt more acutely in those countries that relied more on that export model and that were active, in particular, in those manufacturing sectors that were export-driven. As a result, growth across the euro area has become more uneven. At the same time, this export-led growth model has resulted in persistent current account surplus, increasing our reliance on other countries to generate our wealth, especially to the United States. Euro area residents hold nearly 10% of their total equity portfolio investment in US stocks, totaling $6.5 trillion, about twice the amount that they held back in 2015. Why? Well, this has been a very rational response by the Europeans, because US markets have delivered returns that were roughly 5 times higher than Europe's returns since 2000. But it has created, as a result, a vicious circle. As US markets channel European savings into high productivity sectors, the performance gap between our economies, Europe and the United States, widens, prompting yet more Europeans to channel their savings across the Atlantic. The result is stagnating productivity at home and growing dependence on others. Finally, we now face a new form of vulnerability, not just us, we share it with others, which is the weaponization of dependencies on key raw materials and technology. Our analysis at the ECB is that 80% of large euro area firms are no more than 3 intermediaries away from a Chinese rare earth supplier. Recent supply shocks, for example, the shortage of automotive chips or the threat of it, have shown how a single choke point can stall entire sectors, the automotive industry, notably. Now, these vulnerabilities do not trigger massive, dramatic crisis. Instead, they quietly erode growth as each new shock nudges us into a slightly lower trajectory. And over time, the cumulative effect of this lost growth and lost productivity become material. That's for the vulnerabilities, and we are all saddened by this state of affairs. And yet, as Jean indicated, we are resilient. And I'm going to borrow from him and go a little deeper in some examples without taking too much time, I hope. Because 2025 has exposed Europe's latent strength. Our experience this year has shown that a resilient domestic economy can shield Europe against global turbulence. And I will mention 3 sources of domestic strength that have helped cushion the shocks that we've suffered. I will quote just like Jean: people, our potential, and our policies. I have to do that, right? But first, our people. We have benefited from an unusually strong labor market, one that has remained remarkably resilient even as growth has slowed. Typically, employment tends to grow at roughly half the pace of real GDP growth. And yet, since the end of the pandemic, that relationship has been almost, not half, but 1-to-1 in Europe. And this strength has created a virtuous circle. Rising employment, participation has increased as unemployment has reduced, but rising employment has supported consumption, which in turn has sustained services in particular, and created even more jobs, particularly in labor-intensive sectors. And all of that despite an aging phenomenon that is very specific to the advanced economies, but particularly acute in Europe, and immigration, which is a polarizing and dividing phenomenon. People. Second, our potential. Despite the notion that Europe is lagging behind in AI, European firms are moving quickly through the digital transition, and that is making investment more resilient to global uncertainty. And while tangible investment has reduced in the past 2 years, as manufacturing has weakened, intangible investment has risen sharply, keeping overall business investment broadly stable. Firms continue to invest in AI and digital infrastructure because for any company that wants to survive, this is just not optional. People, potential, policies. Fiscal policy, in particular, has acted counter-cyclically, buffering the economy rather than